Okay, so let's talk about the accounting equation. The accounting equation says that assets must equal liabilities plus owner's equity. Now let's cover some definitions here first. What is an asset? An asset is anything owned or controlled by the business that is expected to be sacrificed at some point in the future in the revenues earning process. So assets are everything from desks and computers and chairs to paper, pens, lathes, equipment on the assembly room floor, your raw materials that might be sitting in bins in the warehouse, your delivery truck if you own it, anything and everything that is owned or controlled by the business that you anticipate sacrificing in some way, shape, or form in the revenues earning process is an asset. Now, assets can be broken down into two categories: current assets and long-term assets. And what distinguishes a current asset from a long-term asset is when you expect to sacrifice it. Okay. If you expect to sacrifice an asset in the current accounting period, it is considered a current asset. If you are anticipating sacrificing that asset at some point later on down the road in succeeding accounting periods, it's going to be a long-term asset. Now, current assets generally take the form of cash and cash equivalents, short-term marketable securities, accounts receivable, merchandise inventory, and prepaid expenses. Those are the five principal categories of current assets. So another way to think about it is a current asset is an asset that you intend to spend, as in the case of a cash or cash equivalent, convert to cash, as in the case of a short-term marketable security, collect, as in the case of an accounts receivable, sell, as in the case of merchandise inventory, or expense, as in the case of a prepaid expense. If you've got an asset that you're doing any one of those two, you're spending, converting to cash, collecting, selling, or expensing, it's a current asset. Okay? A long-term asset is anything that you're going to be sacrificing in future accounting periods. Okay, so those are going to be things like your property, plant, and equipment. Your long-term investments like stocks and bonds that you hold in other corporations or in other entities that you're not going to convert or won't be maturing until next accounting period or succeeding accounting periods. Or intangibles such as copyrights and patents. Those are considered long-term assets also. Now, as far as liabilities are concerned, the same concept, the same timeliness concept applies. If a liability is a financial obligation that the business owes to someone or something, if that obligation has to be paid within the current accounting period or year, it is considered a current liability. If that obligation is coming due in succeeding accounting periods or succeeding years, it is considered a long-term liability. Now, examples of current liabilities are accounts payable. Those are amounts that you owe most typically to vendors. You bought raw materials from someone or equipment that you're going to resell, you're going to put on your shelf and sell to customers. Those are considered accounts payable. They're probably going to want to be paid this period. Now, if you were to buy something and maybe the seller offered you terms like, hey, you don't have to pay me for 2 years, okay, that would be a long-term account payable. But as a general rule of thumb, most account payables are due in the current accounting period. Okay, so they're considered current liabilities. Wages and salaries payable. Okay, that's the amount, the monies that you owe to workers who've worked for you. And by the way, just for quick reference, there is a difference between wages and salaries, just like there's a difference between illiquidity and insolvency, and there's a difference between cost and expense. There is a difference between salaries and wages. Wages are what are earned by hourly workers, whereas salaries are what's paid to people who are paid on a yearly basis. Meaning to say, like, they have a flat salary of $50,000 a year, $75,000 a year, as opposed to someone who's paid $12 an hour. Okay? As a general rule of thumb, salaried workers are not entitled to overtime. That's one of the perks of being a wage earner. So anyway, other forms of current liabilities: taxes payable, interest payable. Maybe you borrowed money from the bank, or you issued a bond, and you have to pay, let's say, $4,000 a year in interest to the purchaser. That's an interest payable. Okay, and when you pay it, well, we'll talk about. There'll be an adjusting entry there. We'll talk about that at a later date. But what I'm getting at is your current liabilities are liabilities such as accounts payable, notes payable, taxes payable, interest payable, wages payable, and salaries payable. Your long-term liabilities are all other liabilities that are not due this year or accounting period. By the way, another current liability could be the current portion of long-term debt. So maybe 30 years ago, I took out a loan. I borrowed money from the bank, or I issued a bond. Better yet, I issued a bond for $1 million. Someone bought it. They gave me the $1 million. 29 years, and I got to pay that $1 million back in the 30th year. For 29 years, I'm going to carry that $1 million as a long-term liability. But in the last year, it's going to move to a current liability because that $1 million is due this year. So liabilities can move across the balance sheet. The same is true for assets. Assets can move from long-term assets to current assets. For example, one category of long-term assets are your long-term investments. So they're like stocks and bonds that you bought in other companies, and even land that you've bought but aren't using. Okay, so maybe I bought an acre of land next to my factory that I'm going to expand to someday. Well, until I actually build on it and start using it, that land is considered a long-term investment. Now, as for bonds, let's say I lent someone $1 million. So I bought $1 million bond from, let's say, the government, the federal government, 30 years ago. So for 29 years, and how a bond works is, in this case, I lent the government the $1 million, and the government says to me, in 30 years, I'm going to pay you back that $1 million, and I'm going to give you 4% interest every year. So 4% on $1 million is what, $40,000. So I'm going to get $40,000 in interest every year for 30 years, and then the $1 million that I gave them, I get that back also in the 30th year. So for 29 years, I'm carrying that $1 million bond that I bought from the government as a long-term investment. And then in the last year, it moves over to current assets as a short-term marketable security. A short-term marketable security is a marketable security, like a bond, a CD, even stocks, that has a maturity of between 90 to 365 days. So it's maturing sometime within the next year, 90 to 365 days. Okay. So that $1 million bond went from being a long-term asset for 29 years, a long-term asset, and then for the first 270 days, that's one way to look at it, 270 days of the year, of the last year, it was a short-term marketable security. And then, when its maturity is less than 90 days, it moves up and becomes a cash equivalent. And the reason why it's considered a cash equivalent at that point is because interest rates are pretty much locked in, so we know what inflation is going to be. Okay, we have a really accurate idea of the value of that asset. Quick deviation, slide trip. A lot of people don't know what cash is. Now, cash is a current asset, that's true. But people think of cash as just being folding money in coinage, and that is not the case. Yes, cash is greenbacks, folding currency in coinage, but it's also checking account deposits, savings account deposits, checks from your customer, certified checks, cashier's checks, and money orders. Those are all forms of cash. A cash equivalent, as well as a short-term marketable security, are things like stocks and bonds that are maturing or being converted soon. They can also be a CD, for example. So, like for example, if I went out and bought a CD, if I bought a 2-year CD today, I would carry that on my books as a long-term investment. And then when I got into the year in which it was going to mature, I would carry it for the first 270 days, the first 9 months, I would carry it as a short-term marketable security. And then in the final 90 days before maturity, I would move that CD to a cash equivalent. Okay, so you can kind of see also with liability, just like with liabilities, assets move across the balance sheet from long-term to current. Accounts receivable, that's when I sell something to someone on credit. Not credit card, but I extend store credit to someone. So someone walks in the door, buys $1,000 worth of computer equipment off my shelf. I extend credit to the person, and the person says, yeah, I agree that, they'll pay me, the first of next month. What they're agreeing to is an account receivable. Now, my account receivable is their account payable. But I would debit, in that case, I would debit account receivable Mr. X for $1,000. I would credit revenues for $1,000, because remember, the revenue recognition principle for accrual-based accounting stipulates that revenues are recognized when the earnings process is subsequently complete. The 4 criteria are met. Persuasive evidence of an agreement, goods have been transferred, costs are fixed, seller's costs are fixed, and there's a reasonable likelihood of receiving payment. So I can recognize that transaction as a revenue transaction. Now, I would also at the same time debit my costs of goods sold and credit merchandise inventory for the amount that equipment cost me. That's another conversation. Merchandise inventory is another form of current asset. That's like the merchandise that I have sitting on my shelves in my store or in the back room or in my warehouse. But it can also be, if I'm a manufacturer, if I'm involved in manufacturing operations, I have to buy raw materials, right? And then as I'm putting stuff together, that's another category. So I've got a raw materials account, and as I'm putting stuff together, I've got something called a goods in process account. Okay? And then as I finish my goods in process, and my goods are ready for sale, I've got a finished goods inventory account. That's really the equivalent of the merchandise inventory account. Now, we will get into all of this in succeeding videos, but what I want you to understand is that a business can have more current assets accounts than just a merchandise inventory. Okay? If you're dealing with a manufacturer, you're going to have raw material accounts, finished goods inventory, and raw material, goods in process, and finished good inventory accounts. Last category of current assets is the prepaid expenses. Now, don't get hung up on the name. Yeah, it has expenses in its name, but it is not an expense account. It is an asset account. Okay. Unearned revenues, by the way, I should remember this. Unearned revenues is a current liability account. We'll talk about that in a second. But the reason why I want to bring that up is you tend to have accounts that have names that can be a little bit misleading. Unearned revenues, you would think is a revenue account, right? It's got revenue in its name. It is not. It is a liability. You have received money for something that you have not done the work for, or you have not provided the goods for. That's a liability. You owe somebody something, $1,000 worth of computer equipment, for example. In the same context, in the same vein, prepaid expenses are not expenses, they're assets. Now how does that work? Okay. Let's say it's January 1st and I'm buying an insurance policy. I keep going back to the same example, I apologize. But let's say I buy an insurance policy for $12,000. Okay. Now the matching principle, we'll talk about this more when we get to generally accepted accounting principles, but the matching principle says that I've got to match my expenses to the time periods in which those expenses generate revenues. That's a 1-year policy. So what I'm going to do is I'm going to expense that policy out $1,000 a month. Essentially, I'm going to expense it. I'm spreading the cost of that asset out, that $12,000 out over the life of the asset, which is 12 months. So I'm spreading out $1,000 a month. So January 1st rolls around, I pay the $12,000. Okay, so I'm going to debit an account called prepaid insurance. It's an asset account. I haven't incurred the expense yet. Okay. I won't incur the expense until, for that month, until the 30th or the 31st of January. Okay. So I'm going to debit an asset account called prepaid insurance expense for $12,000. I'm going to credit cash for $12,000. Then on January 31st, I'm going to debit an account called insurance expense for $1,000, and I'm going to credit the asset account, prepaid insurance expense, or prepaid insurance for $1,000. Okay, so I'm sort of winnowing down that account. Okay, that asset account. So that's a concept of a prepaid expense. Same applies for rent. If you pay your rent up front, like at the beginning of the year, rent on an office building or something like that. Oh, unearned revenues as a current liability. Yeah, let me talk about that for a second. Yeah, like I said, don't get hung up on the name. Yeah, it has revenues in the name. It's not a revenue, it's a liability. Let's say I'm a tax accountant, and someone walks in my door on January 1st and says, Mike, you're a fantastic accountant. I want you to do my taxes this April. Here's $1,000. Can I recognize, and it's cash, $1,000 in cash, can I recognize that as a revenue? No, I cannot. The reason why is I haven't met all 4 criteria. You know, I'm an accrual-based business. I have not met all 4 criteria. Yeah, there's persuasive evidence of an agreement between the principals, but no, I haven't done the work yet. Yeah, I can reasonably estimate my costs. Yeah, there's reasonable likelihood of receiving payment. In fact, I have received payment. But that second criterion hasn't been met. I have not done the work. So on April 15th, when I'm dropping the completed income tax return in the mail, then I can recognize the revenue. In the meanwhile, on January 1st, I've got $1,000 sitting on my desk. Am I just going to let it sit there? No. I'm going to debit cash for $1,000, and I'm going to credit a liability account called unearned revenues for $1,000. And then on April 15th, when I've done the work and the earnings process is complete, I'm going to debit the unearned revenue account for $1,000, and at that point I will credit revenues. That is my recognition right there. There's something I want to talk about that. It'll come to me later. But that's essentially the concept of an unearned revenue.